Hello everyone. Welcome back. Today, we've got some crucial news you don't want to miss. Let's dive right into the top financial headlines and break down what's happening. Breaking news from Bloomberg: ECB momentum for an October rate cut is looking unstoppable. Today's report is crucial, especially given that economists previously anticipated the European Central Bank, ECB, would hold off on cutting rates in October. Just last week, most traders were confident that a rate cut wouldn't happen this month. However, the latest insights from Bloomberg suggest a dramatic shift. For those living in Europe, investing in the region, or closely following the euro, this is a significant development. The report indicates that just 3 weeks ago, ECB officials were convinced that a rate cut in October was unlikely. But now, as they prepare for the upcoming meeting on October 17th, a rate cut seems almost certain. Deteriorating business surveys, inflation data dipping below 2% for the first time in over 3 years, and the Federal Reserve's move toward easing have all put pressure on ECB policymakers to consider a rate cut. The report further explains that more than half of the Eurozone countries are experiencing inflation rates below 2%. Investor sentiment is clear: there's a 90% chance of a rate cut decision this month, making the likelihood of an ECB rate cut on the 17th overwhelming. Initially, many were predicting a cut wouldn't occur until December, but current assessments suggest that October may bring a reduction after all. Martins Kazaks, the governor of the Latvian Central Bank, told Bloomberg reporters, "We will discuss and decide the timing of the next meeting, gathering more information beforehand." Recent data clearly indicates a shift toward a rate cut as economic risks become more apparent. He emphasized that risks related to growth and inflation are increasingly balanced. Unlike the September meeting, which had 2 inflation reports and a GDP update, this council meeting will focus on consumer price data, various sentiment indices, and income figures to inform their actions. The conclusion of the report is striking. As inflation falls and economic activity indicators weaken, the ECB is poised to cut rates in October, with further cuts expected in December. This anticipated October cut, in addition to the planned December reduction, could have significant implications for the future exchange rate of the euro and efforts to mitigate the eurozone's economic downturn. Financial Times report oil prices climb as Iran missile attack prompts supply fears. A recent Financial Times report highlights a significant rebound in oil prices following Iran's attack on Israel, with the backdrop of threats of retaliation from Israel. Fund managers are holding record bearish positions on oil, creating a striking contradiction in the market. While it's easy to draw simplistic conclusions about the Iran-Israel conflict from a political standpoint, the realities of the capital markets are much more nuanced. Investors are putting their money on the line, and their reactions to the missile strikes reflect a complex sentiment. The report outlines how Iran's missile strike on Israel has led to a spike in international oil prices. The military escalation between these two Middle Eastern adversaries has influenced critical funding flows from the world's largest oil-producing regions. Following the attacks on Tuesday, Brent crude oil prices jumped 5%, reflecting the heightened pessimism among speculators who had been increasingly bearish in the weeks leading up to the incident. By Wednesday, oil prices had surged above $75 per barrel, marking a $5 increase in just 2 days. This market reaction is largely driven by Israeli Prime Minister Netanyahu's vow to retaliate, which raises the stakes for potential conflict in a region responsible for a third of the world's oil supply. However, the report takes an interesting turn, noting that analysts and traders believe the market hasn't fully accounted for the risks of further attacks on Iranian oil facilities or Tehran's possible attempts to block the Strait of Hormuz. Despite the recent spate of confrontations, there has yet to be a disruption in oil supply, and the focus is shifting to Israel's next steps. This sentiment indicates that international investors remain cautious, not feeling an urgent need to panic about potential Israeli retaliation targeting Iranian oil facilities. According to Raz Sim, chief economist at the Talk Group, no one truly knows how far this situation could escalate, what Israel's response will be, or how Iran might react. Other participants' involvement is still unclear. Before this conflict, the international oil market had been marked by a pessimistic outlook on oil prices due to a perceived oversupply. This report reveals the dual pressures currently facing the oil market, escalating war risks that could threaten Middle Eastern oil exports and the existing oversupply situation. The juxtaposition of these opposing forces creates a rare and tense atmosphere in the international oil market. In the coming days, it will be crucial to see which way this balance tips, as it could lead to significant fluctuations in oil prices. This developing situation is definitely one to watch. The third report comes from Bloomberg's report "AI can only do 5% of jobs," says MIT economist who fears crash. A recent Bloomberg article highlights concerns from an MIT economist about a potential market crash, fueled by his assertion that artificial intelligence, AI, will only be able to perform 5% of human jobs. This news is particularly significant given the violent upswing in the US markets over the past year, largely driven by optimistic expectations surrounding AI technology. As tech companies in the US continue to promote AI as a major growth driver, this professor's research suggests that the public may be overestimating AI's impact. This inflated expectation could lead to considerable risks in the capital markets, potentially resulting in a downturn for stocks that have thrived on AI hype. The economist in question, Darren Acemoglu from MIT, shared his thoughts with Bloomberg, stating that AI is likely to disappoint those who have overly hyped its potential. "You won't see a revolution," he said. While he acknowledges AI's potential, he emphasizes that the actual effects might be quite limited. His calculations indicate that over the next decade, only a small fraction, perhaps just 5% of jobs will be replaced or significantly aided by AI. For workers, this might be good news, but for companies that have invested billions in hopes of a productivity boom driven by this technology, it's a different story. Acemoglu warned that a lot of money may end up wasted if only 5% of jobs are affected. "If you're only replacing 5% of jobs, that's not a revolution," he added, cautioning that Wall Street and American leadership have become overly enthusiastic about AI. What makes this report particularly noteworthy is that Acemoglu is one of the first top-tier economists to provide a quantitative forecast of AI's impact over the next 10 years. The 5% figure contrasts sharply with the previously optimistic expectations surrounding AI technology, which could further ripple through the market, potentially influencing stock prices for companies like Nvidia. This development is certainly one to keep an eye on. The fourth report comes from Reuters. PM Ishiba says Japan not ready for rate hike after meeting BOJ governor. A recent Reuters article reveals that Japan's new Prime Minister, Shigeru Ishiba, has temporarily ruled out the possibility of an interest rate hike from the Bank of Japan. On his first day in office, Ishiba's remarks sent shockwaves through the yen's value. After a busy day of calls with President Biden and South Korea's Yoon Suk-yeol, Ishiba stated that the Japanese economy isn't ready for further rate increases. He emphasized that he has communicated to the central bank's governor his desire for the economy to progress sustainably, aiming to end deflation and maintain a trend of monetary easing. Before Ishiba's comments, investors had already begun reacting to potential shifts in the central bank's policies, causing the yen to fall from 144.18 to 144.89 against the dollar. Hardman, a senior forex analyst at Mitsubishi UFJ Bank, noted that Ishiba's statements could encourage market participants to rebuild their short positions on the yen, as they anticipate increased political pressure on the Bank of Japan to delay planned rate hikes. From my perspective, this situation highlights a significant point. During his campaign, Ishiba's stance on monetary policy was noticeably different from other candidates, advocating for interest rate increases. However, following his election and the subsequent drop in the Japanese stock market, he quickly shifted his position and called for the central bank governor to pause any rate hikes on his very first day in office. This reflects the ease with which Japan's central bank's monetary policy can be influenced by political leaders, showcasing a clear interplay between politics and interest rate decisions. It's hard to imagine a scenario in the US where a president would summon the Federal Reserve chair to dictate rate hikes. This news underscores the lack of independence in Japan's central bank, which remains susceptible to political pressures. The last significant news comes from the South China Morning Post. In break from tradition, China receives no formal statement from US on National Day. Today, numerous American media outlets, alongside some from Hong Kong and Taiwan, reported a noteworthy development in international relations. The United States has not officially congratulated China on the 75th anniversary of the establishment of the Chinese Communist Party, which coincided with China's National Day yesterday. This marks a departure from previous customs, as both Russian President Vladimir Putin and North Korean leader Kim Jong-un promptly sent their congratulations to Chinese President Xi Jinping, further highlighting the US omission. This situation begs the question, does the US typically ignore the national days of other countries? The answer is a clear no. As pointed out by the South China Morning Post, the US government did send official congratulations to Algeria and Cyprus, both of which celebrate their independence on October 1st. Furthermore, on October 2nd, the US extended similar congratulations to Guinea on its National Day, demonstrating that the US takes these diplomatic observances seriously and recognizes the significance of international celebrations. Historically, the US has routinely acknowledged China's National Day. In fact, the report highlights that in previous years, the US State Department has publicly extended congratulations to China, just as it does with other nations with which it maintains diplomatic relations. For instance, congratulatory messages were sent to China on September 30, 2022, and September 29, 2023, indicating a pattern of recognition that is now absent. The significance of this news extends beyond mere protocol. It reflects a broader shift in diplomatic attitudes. While the absence of congratulations may seem like a minor formality, it carries substantial implications. This change signals a potentially growing rift in US-China relations, emphasizing the increasing tension and deterioration in bilateral ties. Analysts suggest that such actions, or lack thereof, can serve as indicators of the current state of diplomatic relations, often reflecting underlying political and economic tensions. The impact of this omission may resonate beyond symbolic gestures, affecting public perception and diplomatic engagement. As relations between the US and China continue to evolve amidst rising geopolitical tensions, this incident serves as a reminder of the intricate and often fraught nature of international diplomacy. Observers will undoubtedly be keen to watch how this situation develops and whether it will influence future interactions between these two global powers. In conclusion, this news underscores a significant shift in the diplomatic landscape, marking a potential turning point in US-China relations. As the world watches, the implications of this break from tradition will be closely scrutinized, revealing much about the future trajectory of these critical international dynamics. That's all for today. Thanks so much for watching. If you found this video helpful, don't forget to hit the like button and subscribe for more updates. I look forward to seeing you in the next one.